I'm Jeff Benjamin, Wealth Management Editor at ETF.com, and we're here to talk about the bond markets. Where are the interest rates headed? What are the best entry points for investors sitting on a lot of cash? What's up with this forever inverted yield curve? And what the heck happened to the markets last week? We're going to go over all that and more. Plus, we're inviting questions from you, the audience. Before we get started, I want to go around and introduce our panel. Cyrus Amini, Chief Investment Officer at Helium Advisors. Thomas Urano, Managing Partner at Sage Advisory, and Rebecca Venter, Senior Fixed Income Product Manager at Vanguard. Let's go around and have each of you introduce yourselves. Thank you for being here also. Cyrus.
Hey there. Thanks, Jeff. My name is Cyrus Amini. I'm the Chief Investment Officer at Helium Advisors. We're based out of the Northwest. I've been on the RIA side for about 15 years now, and before that, I was a high yield bond and derivative trader at Bank of America. So this is a topic near and dear to my heart.
Excellent, thank you. Thomas, how you doing?
So I'm Thomas Urano. I am the co-CIO at Sage Advisory. Sage is a $26 billion asset manager specializing in fixed income. I have been working in the fixed income markets for almost 30 years. I started my career at Credit Suisse. I traded rates, credit, structured product. I joined Sage almost 20 years ago and have been leading the team here at Sage.
Okay, thank you. And Rebecca Venter, how you doing?
Hey, Jeff, great. Thanks for having me. Hey, everybody. My name is Rebecca Venter, and I'm a Senior Fixed Income Product Manager here at Vanguard. In my role, I really sit in between our active investment team and our distribution arms at Vanguard. So have the unique vantage point of understanding what our managers are seeing in the markets, how they're positioning the portfolios, but also staying very close to our clients, advisors, and trying to understand what their questions are, what their needs are, and then we bring it together to keep our product offer and lineup healthy and relevant. I started my career at Vanguard, and after serving in a couple of different investment roles, have spent the last several years focused on fixed income, specifically supporting Vanguard's active fixed income product lineup. So excited to be here today and get into these topics.
All right, thank you very much. We got a lot to go over, folks. As a reminder, there is a Q&A feature for the audience to send us questions. We'll get to as many as we can, and we're not going to wait till the end. So if you got a good one, send it over. I want to start with the market and the recent market volatility of last week. I know it looked like something that was happening in the equity markets, but fixed income is interrelated. We all know. Cyrus, what is your take on what happened last week, and how does that kind of relate to the fixed income markets?
Fair. Thanks for the question. I think, last week was, I don't want to say a classic example, but it certainly was an example, I believe, of equity markets, especially overreacting to a perceived narrative. There were a couple of different narratives flying around, some of them technically complex, some less so. So most of the action was in the equity markets, but that doesn't mean fixed income was immune. These days, anytime a narrative changes direction, whether it's growth, whether it's rates, less so geopolitical, but anything US focused, there tends to be some implication of the Fed. So I think a lot of the movement last week was really range bound as opposed to an inflection point in the markets. But it certainly provided a kind of an interesting view on kind of where markets are positioned with respect to rate cuts and also what they expect going forward.
Thomas, what was your take on the markets of last week? I think the S&P was down 3%. I think the ETF QQQ was down almost 8% over the first 3 trading days of August. How did you see it?
So I think there's two things that were happening last week and kind of created this perfect storm that caused volatility. I think in the background was this yen carry trade unwind that had been going on. And that started a few weeks earlier when the BOJ changed their policy stance. They raised rates. They indicated they were going to kind of slow QE over in Japan, and that created a lot of a sudden shift in the value of the yen, and then this whole yen carry trade started to unwind. That was fine, sitting in the background and happening. That wasn't the big concern. I think ultimately what happened though was when that jobs number came out, the sentiment in the investor base here in the U.S. suddenly shifted from the hey, everything is fine, soft landing, no landing, to soft landing, hard landing, recession risk is back on the table. So a little bit of a panic moment there on the economic outlook. And when you try and maybe de-risk your portfolios in August, which is traditionally a low liquidity month, that ran into what was already happening in terms of that yen carry unwind, and kind of voila, you had this spark that created this volatility. So I think a lot of it was technically driven, combined with that I'll say, realization in the investor base that maybe the economy is not quite as strong as we had thought.
Rebecca, it's more than a week now since the Monday kind of sudden drop. Obviously, there were things building into that and building up to that point, but the markets have largely recovered from that point. How do you see that particular event in the context of where we are right now?
Yeah, I think Cyrus and Thomas did a great job explaining what drove that volatility. I think we'd make 2 points just digesting what happened over the last 10 plus days, which is first, we're not terribly surprised by how the data is coming in, at least on the economic front. There are going to be points where there's going to be data that comes in outside of expectations, but we would always encourage investors to think about the trend line, not focus too much on one data point. And largely, as we look at the economic picture on inflation and the labor markets, it's largely playing out as we would expect. We were coming from a very strong period of growth, very tight labor market. And in order for inflation to come back to target with the monetary policy efforts by the Fed, we were going to see this sort of cooling off of the economic picture. So while the market may overreact in the moment, these things are to be expected. So investors should definitely keep that back of mind as they're seeing what's happening. Just kind of try to sit through the volatility. The second piece we're just reflecting on as we look over the last 10 days is just let's acknowledge the power of fixed income. We're here talking about fixed income today, and I think we're coming off of a couple of years where we saw more positive correlation between equities and fixed income, and we started to hear a lot of questions about, does a balanced portfolio still make sense? Is fixed income going to play that role as a ballast? And I know we're going to dig into this a lot later in the conversation today, but we did see that back on display over the course of the last week, where fixed income did provide that ballast when we saw weakness in equities. So that's something that we would really want investors to just think about and take away from the experience in the recent period.
Rebecca, I want to stick with you for a minute and ask you about the outlook for a recession. I saw a report today from Bank of America saying that the recession outlook is slim to none at this point. I don't know. This seems like the most anticipated recession in history, or at least as long as I've been doing this kind of stuff. What are your thoughts on recession at this point, or is it just some big scary thing that we have hanging out there?
Yeah. Well, our team likes to take the approach, our active investment team takes the approach of thinking not only about the base case, but just thinking about the potential scenarios that could play out in the market and assigning different probabilities to them. This really helps our team think about what the full spectrum of risks are, helps them to assess risk more appropriately, and then potentially find opportunities in the market and for the portfolios that can work across multiple scenarios. So that being said, we do have a base case, which we would say is the highest probability economic outcome. And in that base case, we're not forecasting a proper recession. In our base case, I describe it as being a little bit more optimistic than what we're seeing as consensus for this year. So we think growth can hold up better than expected this year and end the year around trend, but with policy really taking more of a bite next year and leading us into a period where we're probably going to see below trend but not negative growth in 2025. We kind of base that view of not trend growth but not recession as our base case around just the strong starting point that we have. We know that the corporate picture is still very healthy thanks to a lot of smart balance sheet management in 2020 and 2021. The consumer, for the most part, is still fairly healthy. So we think there are a lot of strengths that will keep us from dipping into a deep recession in our base case. But that there will be some impact to growth, the labor market, et cetera, as inflation comes toward trend. I will say we do consider, as I talked about scenarios, we do consider the possibility of a recession. It's definitely not a zero probability outcome. And so we think about what that could look like. I know we're going to talk a little bit more probably around what this means for the Fed, but we would say it's a potential for a recession, but not our base case and a lower probability outcome.
Okay. I loved your reference to a proper recession. I'm not sure if that means like a full-on good recession or one. It sounds like you're talking about something, it's bad, but it doesn't technically qualify. I'm guessing, right? When you say proper recession.
Yeah, with a period of negative growth.
Okay.
Yeah.
Okay, Thomas, what's your outlook? Are we okay?
I think we're going through a period of weakness. I mean, just in thinking about growth in three stages, we're either going to be above trend growth, trend line growth, or below trend growth. I think we're moving towards below trend growth. The economy
Mhm.
did quite well over the last year, but I think that all of the juice that really drove it, a lot of stimulus and federal spending is running out of gas. I'll give you a couple of reasons. Number one, here this last round of earnings season was there were some interesting takeaways, but I could sum it up as this: top line misses, bottom line beats. Right? What does that mean?
Mhm.
Revenues have been disappointing, but cost controls and margin expansion have helped companies beat on the bottom line. But you can't run cost controls and margin expansion forever without sales growth kind of coming back online. So it's not long-term sustainable. And then on top of that, like the outlooks that companies had discussed in their earnings calls, most of these companies were guiding lower in terms of revenue. So they're not expecting an uptick in sales, and that's problematic. And then more importantly, companies that are most closest to the consumer were all really weak. Travel and leisure outlooks were poor. Restaurants, interestingly, consumer packaging demand was very poor. So there's some certain segments and takeaways out of this earnings season that really point to some weakness. And then I think as it relates to the bigger picture, which would be labor and inflation, how do companies respond to this? By less labor demand, right? So you've seen the unemployment rate jump to 4.3% in July, up from 4.1. And by the way, the Fed had predicted 4.1 by the end of the year. So we're already above that. And then also notably is over the last year, government dependent jobs have made up the majority of job growth, right? So that's education, healthcare, social services, and direct government jobs have been the bulk of labor growth over the last year. Private sector cyclical jobs are much more challenging to find. And that manifests in a pretty weak hiring rate that came out in the JOLTS data recently. It was only at 3.4%. That was the lowest since 2020. And before that, you had to go back to fourth quarter of 2013 to get a hiring rate this low. So there's some very obvious signs of weakness in the labor market. But at the end of the day, what is all of this coming from? It's because this is the battle on inflation. This is how you fight inflation. You cause the economy to slow down, companies demand less labor, less aggregate demand. And what do you end up with? You end up with softer PPI that we saw today. CPI comes out tomorrow. All eyes are going to be on that. Expect it to be a little bit softer also. Excuse me. And so we're kind of winning the battle on inflation. And to that end, I think that just says, that opens the door for the Fed to begin the process of policy normalization. I'm not going to say the Fed's going to cut rates to try and stimulate, but 5.5 is pretty restrictive, it looks like at this point.
Cyrus, what are your thoughts? Are we winning the battle on inflation? And we're going to get right into the Fed after that answer, because I want to know what you all think the Fed is going to do and why and how.
Of course. Yeah. So I think with respect to, the battle against inflation, I think it's fairly clear from the trend line of the numbers, going back to Rebecca's point and also what Thomas just mentioned, the numbers have been moving towards the Fed's target. I think the market and especially a lot of investors that are, that we're trading with or that we're giving advice to are really, I think they're focusing a little bit too much on the kind of specific point target of the Fed must have this amount of inflation, right? Or 2%, when really we're talking about ranges and probabilities. So I think that tends to exacerbate the market swings when we get to these types of moments where the Fed may or may not switch their stance on policy. I know we'll get more into that in a few minutes, but my thought is that the Fed is doing well in terms of being data driven and patient in how they battle inflation. If you look at where it is now versus a year and a half ago, it is a world of difference. And then and to another point that Thomas made, he was looking at it from kind of the supply side or the kind of the corporate earnings side of things. As I think about the economic outlook and whether there might be a recession, I rate the probability of recession in the next 6 to 12 months is quite low. But I think more pertinent to this conversation, I'm looking at really kind of those demand factors. Thomas had mentioned those companies that are closest to the consumer showing the most weakness. And even just anecdotally, when you go around and look at the different businesses in town, a lot of people are hiring, but no one's able to work those jobs. It's a very, kind of disjointed labor market that I see. So, and I'm also seeing a lot less, let's say, positive stimulus or positive pressure from the consumer side. You aren't seeing people going out and spending, X, thousands of dollars on, a new house renovation or, using up money that they had saved during their COVID lockdown. So I think with some of those stimuli kind of backing off, I do think we're seeing some weakness in the consumer. And I think that's, that being 70% of our economy, I'm paying probably the most attention to that, the strength of the consumer and when that may fade more, because I think that's going to be the determining factor as to when or whether we go into a recession.
I'm going to stick with you, Cyrus. And I want to start at the end here. Did the Fed wait too long to cut interest rates? And they haven't even cut yet.
No, I don't believe that they did. The reason is simple, is because the trend line on inflation is moving towards their target. So that's one of their two mandates. And the other is the labor market. And while the labor market is showing signs of softening, it isn't showing signs of falling off of a cliff. And periods of below trend growth are natural. It isn't supposed to just go up and to the right at a certain fixed percentage each year, or down and to the right. It's supposed to fluctuate. So no, I don't think the Fed waited too long. I think the Fed, some people would argue that they are, let's say, overusing or overextending themselves in terms of communication as a policy tool. I agree with that in part, but I would say that the Fed is doing pretty much exactly what it said it would do all along, which is we're going to look at the data and we're going to communicate with you all via our typical channels, whether it's the meeting minutes or the individual governor speaking. And they've stuck with that approach. So I don't think the Fed has waited too long. And as for whether that cut needs to come 3, 6, or more months out, that I don't know. But I think it's still a little bit too early to look for them to put cuts on the table. Now, I think is a period for wait and see, consolidate, see how the consumer data comes out, see how things come out closer to the end of the year. Let's establish some trend lines going forward. Then they can figure out monetary policy for the future.
Okay, Rebecca.
Sorry, Jeff, I was going to just add on to this while we're talking about this idea of did the Fed wait too long? I think one thing to recognize in this is the Fed wasn't the only player at work in the economy over the last 2 years, right? The fiscal side of the equation was working as diligently and as hard as the Fed was to combat inflation. The fiscal side of the house here, the spending side of the federal government level, was working equally as hard to stimulate the economy and grow. We had one of the largest federal deficit spends we've had outside of any sort of economic crisis or emergency or recession. So massive amounts of stimulus were offsetting what the Fed's policy rate was intending to do, which was to slow the economy. But I think as you look at the breakdown of the federal budget now, with monies getting diverted towards interest expense moving forward, less stimulus money going out the door, the deficit is still high, but the stimulative impact of it is starting to wane. So I just think it's important to recognize that while some may argue the Fed has been sitting around waiting and waiting, I think one of the other things to recognize is that they were also working against the current of federal spending.
Okay. Rebecca, I want to ask you to grade the Fed at this point. We came into the year, a lot of people were saying multiple rate cuts this year. It's mid-August right now, and there's been none. And then, Thomas, I'm going to go back to what you said about the debt, because it was a question from our audience on that question. So if I forget, please remind me. Go ahead, Rebecca.
Okay. Well, I like a lot of what Cyrus and Thomas said, just around putting into context what the Fed has been looking at. I think there are a lot of market participants and other folks out there suggesting that we're at a point where the Fed has waited too long. But I think that could be a little bit of revisionist history at play right now. If you think about, let's turn back the clock to the end of last year, beginning of this year, it did look like a period where the data had kind of come into balance. The inflation picture was looking really good at the end of last year, where to the point where a lot of folks came into this year expecting cuts early on from the Fed. But then what did we see? We saw multiple months of inflation data that came in above expectations. We saw rates selling off in conjunction with that. And at that time, it felt very understandable why the Fed had the patience. And I think it's important to see that they did look at the through line. They look at the long-term trends and had the patience at the end of last year and through this year, which in our view has been appropriate. As we think about what we're expecting just in the near term, I mentioned that our view is one that we're not expecting a large collapse in the labor market. We're not terribly concerned about the movement we've seen recently. We also see that there is some potential for a little bit more stickiness on the inflation side, and just the point of strength on the economic side that we're starting from keeps us in the mindset of we're likely to see things go pretty well this year, growth likely to hold up. And in that environment, from our perspective, we're probably seeing about 2 cuts as reasonable. So we are a little bit below where the market is pricing right now. Just look, before I came into this call, I think we were seeing about a little over 4 cuts being priced by the market for this year. And in our view, unless the data really were to take a turn from here in the near term, we're unlikely to see that level of easing.
Okay, 2 cuts. Do you see a cut in September?
Yes, that's our expectation.
All
We
right.
think, given the recent inflation data, what was communicated in the last Fed meeting, definitely followed by then the weaker than expected employment report numbers, we are expecting that those things have sort of paved the way for a cut in September, and that's reasonable to expect.
Okay, Thomas, I want to ask you when you expect a cut, or if you do. But also, here's the question that came in from our audience. All else being equal, does the growing national debt affect the interest rates paid by mid and longer maturity treasuries?
So that's a good question. I'll come back to that in just a second. But the answer to the first question is yes. We expect the Fed to start I'm going to call this normalization process. Starting in September, I think they can take a nice leisurely pace of 25 bips a quarter, somewhere along that pace. And again, the ballpark here isn't to stimulate the economy. The ballpark is the game here is to become less restrictive. Economy's flowing nicely. It's not falling off a cliff. So they can kind of ease their way back down to what they would deem as a neutral rate. It's just difficult to know what that neutral rate is. And I think another catalyst, I think that helps us feel more convicted that the Fed is about to embark on this process. There was a recent report out by the Atlanta Fed that discussed the differences between the establishment payroll report and the survey report. But long story short, the first key takeaway of their Atlanta Fed research was that the birth death model adjustments were overestimating job growth in the U.S. by about 440,000 jobs over the last year. So I think labor market weakness is there. I think that's given the Fed enough cover then to begin the process of cutting rates. So what does that mean ultimately for, obviously short-term rates go lower? Is that going to affect the interest expense on long-term bonds in the market for the Treasury? No, those are fixed and they're there and they're stuck. I think what's more important to think about in terms of interest costs by the federal government is the mix of bill supply versus longer maturity coupon supply. So T-bill supply is running exceptionally high right now as a percentage of outstanding debt. It's much higher than it normally is. I'm not exactly sure why the Fed or why the Treasury is funding itself in that way. Maybe concerned that there's just so much coupon supply that there's just, it would overwhelm the market. And quite frankly, I think if the Treasury decided to try, add another $500 billion of coupon supply, it might be too much for the Treasury market. So that's an issue, but ultimately, if the benefit for the Treasury is that if we do see rates come down, then the T-bill market, which turns over much quicker. Keep in mind, T-bills are paying out interest expense somewhere around 5.25 right now. Those are going to roll over, and if they refinance it with further T-bills and continue to ride policy rate lower, that's going to give a little bit of breathing room to the federal government in terms of interest expense. So it could work out in the Treasury's favor here. Not that the Fed and Treasury are trying to help each other out, but certainly coincidental.
Okay, Thomas, quarter point in September. Oh, 1 second, I'm going to get my scoreboard all kept up here.
Sure.
Rebecca, quarter point in September? Okay, yes, Cyrus.
Well, I would say probably no to the quarter point in September. I'm not going to take it completely off the table, but I do think it's a bit premature because the data hasn't fallen as much as I would expect it to before they felt the need to start that movement. 2 comments. One would be to Thomas's point about the kind of the Fed and the Treasury and kind of managing the balance sheet, if you will. There's been, I think it was J.P. Morgan that put out some research recently regarding the uptake on the Treasury auctions, and there have been some really weak Treasury auctions out there over the last couple of months. And so if they're not doing well in the primary, where there are not necessarily forced buyers, but at least large numbers of institutional buyers, that type of weakness is eventually going to percolate out to the secondary. So to the kind of the day-to-day trading of treasuries, whether they be bills, notes or bonds. So I think it's worth noting that you'd ask a question there about how is the deficit or how is the rising interest costs of our balance sheet going to affect kind of the country or our outlook going forward. We'd be remiss if we didn't point out it's concerning. You can't fund things indefinitely with debt. There has to be at some type of kind of debt normalization plan, and we don't have one. And we do enjoy the privilege of being the world's reserve currency. But if you look historically, that's not a status that many countries or empires have had for long. So, to assume that it will run indefinitely into the future, I think is a dangerous assumption, because we have to maintain our competitiveness. And part of that means we have to show that we have fiscal restraint, that we can balance our spending and our budgets. And right now, we're not doing that. So in the long run, that is going to weigh on what the Fed and the Treasury can do. And it is going to express itself in the longer end of the curve. But as Thomas just pointed out, the repricing is all happening at the front end because that paper is all turning over. So we'll see what direction policy rates take. But at some point, people are going to start paying attention to how much debt we truly have outstanding and whether we're going to be able to make up that difference in our lifetimes, frankly.
Okay, if you're a financial advisor, as most of our audience is, how do you navigate client portfolios through the scenarios that we've just talked about for the past 28 minutes? Cyrus, I'm talking on the fixed income side, and I know we're just kind of hashing things out here right now. Nobody's gonna call you up in 6 months, Cyrus, and said, hey, you were wrong, or thanks, you were right.
That's okay. I reserve the right to change my mind based on the data. So, in terms of what I've been discussing with clients really over the last almost a year now, is that with rates backing up, there have been significant opportunities in fixed income markets. Some of it due to outright dislocation, and some of it due to I would say issuance at just higher levels of coupon. If you have told me 6 or 7 years ago that that the bogey of let's call it 6 to 7 was going to be achievable without really taking much risk, and I'd be able to do it in fixed income, on behalf of most clients, they probably would have snapped your hand off. So, the fact that we're sitting here now and people are wondering whether, a 5 to 6 to 7% return in fixed income is that good? Is that a good time to get in? To me, that question answers itself. So I have been and will likely continue to guide clients to saying, shorter on duration, and more up in credit quality. And we've used funds or strategies such as JPST, which is JP Morgan's ultra short-term fund. We've used G-bill to access treasuries. And then we've also used JAAA, which is a Janus Henderson fund that focuses on the AAA tranches of CLOs. So these are all yielding, call it anywhere from 200, let's say 100 to 200 bips above what you would get on risk-free or on cash. And you're taking very little duration risk, and you're really taking quite little, if any, credit risk as well. So it's not quite free money, but in terms of fixed income markets over the last 10 years, I think the last year has been an environment rife with opportunities, and that window of opportunity has not closed yet, in my opinion.
Okay. Rebecca, would you be able to give us some kind of actionable strategies against the backdrop that we've kind of laid out here with the Fed, recession, economy?
Absolutely. I'd also just start by saying, agree with a lot of what Cyrus laid out as far as the opportunity in fixed income today. If we are comparing where we are today relative to when we first started seeing the articles come out, bonds are back, there's interest in fixed income again, that probably started happening around 2 years ago. And if we look at where we are today, we'd say the case for bonds is probably even stronger at this point. So at a very high level, we are seeing much higher levels of yield that's available to clients today than we've seen historically. And not only are you getting that yield, you're getting a return that's really attractive, even relative to when our team projects equity returns 10 years out. We think that fixed income returns are going to be highly competitive there with equity returns. And also you're getting that return at a much lower level of volatility. Not to mention, we've spent some time talking about some of the economic risks we're seeing. Economic cooling doesn't sound like any of us are calling for a sharp downturn in the near term, but what you do get with fixed income in that environment is that ballast in your portfolio. And we know, as we've talked about, that's back in play. So for all those reasons, we do think it's a great time to be reallocating to fixed income if you are an investor who's been maybe a little bit heavier in cash relative to your long-term fixed income target. When we think about how to actually execute on that, a lot of times we're just having conversations about the core. We think that for a lot of investors who are allocating to fixed income, starting with some sort of ag-based product is a great place to start. And of course, you can make the choice between an index product or an active product. At Vanguard, we are fortunate to offer both, and we think both can have a lot of value for investors. It all depends on their use case, their risk tolerance. But we've been investing a lot in our active capabilities at Vanguard. And maybe lesser known to different audiences, but We actually have a very long history. Our firm began with active, and we've been managing active fixed income portfolios for over 40 years. So one area I guess I'd point investors to when we're talking just about the core is you can get high quality active strategies like Vanguard's Core Bond Fund at a very low fee. But you can also, you're starting to see a lot of firms offer that product now in the ETF structure. So we were excited to launch our active core and core plus ETFs. Those are VCRB and VPLS at the end of last year. So we're excited to kind of extend that active management in the core of a fixed income investor's portfolio in the ETF structure. And I guess I'd say it's a great place to start if investors would like to be a little bit shorter duration, given some of the risks we've been discussing. It can be great to pair a core ETF with something like an ultra short. I'll mention our ultra short bond ETF, VUSB, which has a 1-year duration. It can be a good lever for short-term liquidity needs, but also to sort of manage the overall portfolio duration. So those are a lot of the conversations that we're having today as we're talking with investors about reallocating to fixed income and what we think is a really good time to do so.
I want to stick with you for a second here, Rebecca, on the ultra short. And I've heard, actually today, I heard some advisors talking about ultra short ETFs. Is this a kind of like a transition away from cash, or what's the appeal? Why go ultra short right now?
Yeah. Well, in our view, it would be, we view cash as an investment that's less than 6 months, one that you need liquidity within the next 6 months for a particular purchase. And then we think of short-term bonds as sort of that liquidity allocation for potential needs occurring within 2 to 3 years. And that's generally how we think about money markets versus short-term bonds. We think ultra short sort of fits that intermediate bucket for investors who have an investment time horizon of 6 to 18 months. We manage our active ETF in ultra short at around a year duration. So it works well for that time horizon. It also allows investors to get a yield above treasuries on a, with a pretty consistent level of returns, lower volatility, but also in this environment, as we're talking about the Fed potentially executing multiple cuts over the course of the next 12 months, we know that that presents a lot of reinvestment risk to investors who are more allocated to cash today. So in ultra short, it's a 1-year duration. So it's not a terribly long ETF relative to some of the other products on our lineup or other products out there, but it would give investors a little bit more of a chance to lock in some higher yields in that short-term part of their portfolio today. And in the case of, worse economic outcomes, there is some duration to that portfolio. So you are getting a ballast relative to what you'd be getting in a cash portfolio. So that's how I'd make the case for ultra short.
Okay, thank you for that. There was a lot of questions about that, so I'm glad you cleared that up. Apparently, you got some fans out there, Rebecca, sending us in questions specifically for you. Also getting a lot of really good questions, folks. So I want to, encourage you to keep sending them. We're going to get to as many as we can. A couple of them are related to duration. And Thomas, I'd like you to, in the context of giving us kind of an actionable strategy for this market environment on the fixed income side, can you talk to us a little bit about duration, how it works, and why it's important to pay attention to?
Yeah. Listen, the question about what do you do now at this point in the cycle, in the fixed income cycle? It's a simple answer. You extend your duration. Most people have been hiding out in cash for the last 24 months. It's been a great place to be. You've generated a 5-ish% yield on it recently, and you've won the battle. You did it. You won the battle. Notice what the discussion that we're not having is the Fed going to raise rates again? That's not the discussion we're having. The discussion we're having is, when is the Fed going to cut rates, right? And to that end, what does that mean? That means it's time to take the money out of cash, out of ultra short, out of very, 30, 60, 90-day money, and invest it into longer maturity bonds. Why do you do that? Well, first and foremost, and the most simple explanation is you want to hold that yield longer. If you sit in cash and the Fed starts cutting rates, the 30-day reset, the 60-day reset means your yield on that cash is going to go down and you're going to earn less. So what do you want to do? You want to extend the maturity of your fixed income positions for income stability, number one, and just hold that income for longer. And second most important thing, again, the discussion we're having is, when will the Fed cut rates, implying rates will go lower from here. And in that scenario, you're going to see upside in terms of price appreciation, right? So not only will you be able to hold your coupon longer on bonds, but you're going to see some upside in terms of price. You look at the overall yield in the market, look at an ag strategy was referenced. That's kind of the general kind of generally accepted index in the bond market, you can get somewhere near a 5% yield in an ag strategy, right? In a passive strategy, throw active management on there, and there's some, you can get maybe north of 5% yield on there. Look at the yield on that index going back over 25, 30 years. You have to go back to pre-2008 before you were able to earn a 5% yield on the ag index, right? So it's been well over a decade since you've had this particular opportunity to put yield into your portfolio, number one. Number two, fixed income is starting to act like a diversifier again against equity performance. And we saw a nice glimpse of that last week. Number three, historically, when the Fed is done hiking rates, it pauses and then pivots into a cutting cycle, the bond market does exceptionally well. Why is that? Because yield is your number one indicator of your expected return. So somewhere in and around a mid-single digit yield will drive your return, plus or minus changes in interest rates. Well, our expectation is going to be in addition to that, right? If rates go down, you're going to get some price appreciation. Historically, coming out of hiking cycles, the bond market has generated high single digit returns for the following 24 months. So there's still plenty of runway to allocate into a core strategy in the fixed income markets. Now, do you do that in passive? Possibly. Do you just do it blindly? No. Why is that? Because as we're going into an economy where we're talking about recession risk, possibly, right? Rising default risk, delinquency issues in the consumer credit markets. There are things to do in the fixed income markets where you want to make sure you're allocating optimally within that. So to that end, right, here's why I shamelessly plug an ETF. Sage is one of the sub-advisors on Investment's active passive bond fund, so ticker APCB. But there's a scenario again where you can incorporate some active allocation movement within strategies in a core, kind of a broadly designed core strategy in the fixed income markets. But I think it's important to recognize too where we are in the cycle. This is the Fed. We're talking about the Fed cutting rates. We're coming out of the hiking process. Long-term return historically supports favorably positive return profiles in fixed income at this point going forward. So you won the battle by sitting in cash. It's time to move it out.
Okay. A lot of talk about duration, which is good, and apparently it's striking a nerve with our audience. I'm going to put two different questions. I'm going to put them together and throw them at you, Cyrus. One is adding duration where, ... And the other one is, if the Fed is about to start a cycle to reduce interest rates, is there any harm in buying long duration bonds, 20 plus year, with investment grade quality and locking the yields for the long term?
I'm going to go in reverse order, if that's all right. I think the answer to the second, if we're talking about, kind of longer term corporate issuance, I think the answer to that is really part of it has to do with, the actual credit underwriting there. If you're going to invest, whether it's through a fund or if you're going to go directly to that fixed income issuance, there are companies there that are going to have to refinance during this period where rates are still elevated. And then let's say that the rates don't move that much over the next year. There's going to be more opportunities where companies have to come to market and refinance. And there's going to be some good chances out there in a variety of industries to go find good opportunities. So there isn't one place that I could point to and say, well, go look here for, 20 year, or go look here for long duration. I would say generally I'd be looking for it more so in, the higher investment grade corporate world as opposed to doing it in treasuries. I think there's also a case for, there are still opportunities in the muni market and the agency market. And whether it's through, again, either going through the funds or going direct, there are opportunities to lock in those rates. I think there will be more opportunities that come up over the next months, maybe it's another year or two, maybe longer, where, again, issuers, whether it be governments or corporates, they're going to have to come to market. They're going to have to accept whatever the market price is for their financing. Odds are the coupon there and the yield is going to be higher than what we've seen for the majority of the last 20 years. So, as Thomas, I think, said several times, and I agree with, while the sun's out, make hay. And, this is it's a great opportunity that the clients and investors should be looking at carefully. And then the other question was, was duration,
just duration. Add duration where? Where is the place that you should be adding duration, or is it everywhere?
I don't believe it's everywhere, and there's a variety of reasons for that. But really, most simply, it's that you want to be cognizant of where you're taking your risks, and you do ideally want fixed income to be a separate driver of risk and return than equities. So I do think that with the uncertainty that there is now in terms of policy rates and growth rates around the world, that going out immediately to the long end of the curve is perhaps a little premature. I think you could move out a couple of years in duration, probably both on the government side and also the corporate side. But I would suggest doing it, in a measured fashion. We talked a little bit earlier about ultra short, and why has that been, kind of top of mind, or on the subject of more conversations. It kind of goes toward another point we're probably going to address, which is curve inversion. If you're getting better
Mhm.
rates at the short end of the curve, why would you invest at the longer end of the curve?
Right.
There's no logic to that trade. So, as long as that curve, stays inverted, and the rates that you're able to get by investing at the front end of the curve, as long as they're, higher, risk-free plus spread, it makes sense to invest there. Do you have reinvestment risk? Absolutely, right? But you have the farther out you go on the curve, especially if you're going to lock something in, whether it's via a bond ladder or if it's just via individual securities, you have to really do your homework in terms of underwriting the credit and making sure that it's appropriate for that client, and that realistically they're comfortable holding it for a long period of time, because you've got to be comfortable with price fluctuation in order to get you to that yield point or that yield target that you're looking for.
Rebecca, where would you go on duration if you were advising clients? And you can pick any generic client if you want, but and Cyrus opened the door, so let's go into the inverted yield cave, inverted yield curve cave. Try and say that, and help us understand that. I mean, this is like I think this is history's longest inverted yield curve. So I've always wondered, like, does this matter at all? But anyway, first of all, Rebecca, what is the strategy in terms of duration? I mean, you can't just say duration and then expect everyone to understand what they're supposed to be doing.
Right. And I would say that it really depends on the investor and the investor's use case. So it's definitely a fair point, Jeff, that I've seen a lot of articles out there. This is the time to extend duration. And I think we've all kind of discussed that that's probably true, generally speaking, but it really depends on your starting point and what your goals are as an investor. If you are an investor who has more of a shorter term time horizon, or maybe who has more fear that rates may not stay at these low levels, maybe it sounds like the collective views of the group are that rates are probably more so on the downtrend from here. But if investors have more of that shorter term time horizon, they may want to pick products that are stepping out from money market funds, but don't go fully into the duration of the ag or something longer term like what we've been discussing. So there are a lot of products you can put together to get you a portfolio there, combination of short-term bond funds and ETFs, or intermediate term bond funds and ETFs. But if for sort of the average investor just allocating to fixed income and looking for that ballast, I'll just call back something that I mentioned earlier in the call, which is the sort of core bond portfolio, which has a duration of around 6 years. It covers the broad US bond market. So you're getting sort of broad exposure there to a diversification of maturities. That can be a really good landing spot for a lot of investors, because when you're going that far out on the curve, you're typically getting a decent level of yield as we look towards an upward sloping curve at some point, likely over the next year. And you're also getting a level of duration that if rates do fall, as the economic picture cools, you're getting that ballast in your portfolio. So we think for a lot of investors, that can be sort of the sweet spot, and they can tailor around it. But sort of that 6-year ag starting point, we would generally agree with some of the points made around buying very long-term bonds. For a lot of the reasons discussed, there's some value there in the concept of locking in this longer term yield, these higher yields for the longer term. But definitely there are a lot of risks associated with that. And when you're taking that level of duration and interest rate risk, there can be a lot of volatility in that type of a portfolio allocation. So yeah, generally we would point back to, for a good starting point is that broad market exposure, sort of the ag at around 6 years duration, and pivoting from there depending on your particular needs. What you mentioned a little bit about the yield curve inversion, though, and where that's headed, it has been the longest inversion. I think that's an accurate statement. But I'll point out that, as we would expect, we are seeing the curve disinvert. So if you look at the 2-year, 10-year, which is a popular way to measure the inversion or the slope of the curve, that has disinverted meaningfully over the last several months, as we have seen data cool down, as the markets increased its expectations for cutting by the Fed. So we have already seen the curve steepen. We even saw at points last year where you see the curve farther out, think 5s, 30s, or 10s, 30s. We've seen the curve slowly disinvert from sort of the middle out. Now we're seeing closer points like the 2-year, 10-year steepen. And this is broadly our active team's expectation, is that we will continue to see the curve disinvert. And if we look at the 2-year, 10-year, I think last looking at it was around 10 basis points inverted. So almost at a flat curve there. Of course, with something, if you're looking at the 3-month, 10-year, that is going to take time and actual easing by the Fed for that curve to disinvert. But based on our outlook, which is for the Fed to likely deliver 2 cuts this year, and in the base case of slowing growth next year, we would expect the Fed to be cutting towards our estimation of neutral, which is somewhere around 3.5%. And in that environment, we would expect the full curve to be disinverting by that point.
Does it require the Fed's help in order for the curve to disinvert or get back to normal, or whatever the word is?
For the full curve, if you're thinking about how to think about the curve, the very shortest term maturity, so you quoted the 3-month, 10-year, that's going to be since that's only yields over the next 3 months, that's going to be very closely tied to action by the Fed. Of course, the Fed is managing the overnight rate, but everything that's on the very front end of the curve is going to be very closely tied to Fed policy. So that will require, if it were to see that invert with the rest of the curve, typically that does require the Fed to actually be easing policy.
Okay, Thomas, do you worry about the yield curve, and should investors? To me, if it disinverts or goes back to normal, or longer term bonds pay more than short term bonds, it seems like it should flip some kind of a switch for financial advisors allocating to bond, in their client portfolios, right?
Yeah. I mean, listen, the yield curve has been steepening, as Rebecca mentioned. It's nice to see that 2s, 10s at -10. It was minus 100 basis points at one point earlier this year. So that's an important thing to recognize. How do you capitalize on that, right? And I heard the question earlier: should I go out and buy like 30-year treasuries or 30-year bonds? I would say no to that question, and I would say yes to recognize what the steepening yield curve means. That means shorter rates are going to be lower than longer rates. However that happens, if longer rates are going up or if short-term rates are going down, either way, you want to kind of be exposed to, the front end, to the belly of the yield curve, where we would expect, in the scenario where the Fed is cutting, rates to fall, right? Now, some may argue that the curve could actually twist. Maybe if the Fed cuts too aggressively and overstimulates, that could kind of reignite inflation concerns, and you get inflation premium back onto the back end of the yield curve, and 30-year yields could actually drift higher with higher inflation premium or inflation risk. But I think one thing is clear: if you're allocating, think about where you want to kind of position most of your rate sensitivity. And to do that, you want to get it with your rate sensitivity focused on, 2s, 3s, 5s would be the most optimal way to do that. You can still get that in a core bond strategy, because a large portion of those types of strategies are allocated inside that, or in that portion of the yield curve. But again, thinking about the yield curve re-steepening, whether it's a bull steepening, meaning front rates go down, if it's a twist where long rates go up, I think your best risk reward scenario here is not to chase that high duration 30-year exposure, combined with a lot of short cash yield. Just focus on that front of the yield curve, which is going to be the most sensitive to Fed cuts.
Cyrus, do you want to jump into the yield curve debate, or should I move on?
I thought you'd never ask. No, Thomas made a really good point there, and they both did. And I think, it's interesting. I'm going to come at it from a different angle, which is, we're talking about, the normalization of the yield curve, or, money being more expensive the farther out you go in time, which is not the case right now when you look at the curve. Thomas referred to it as a twist, which I agree with. But however you look at it, there's no rule that says the front end has to drop in order for the curve to normalize, or for the curve to have a positive to negative. So if we're looking at literally the very short end of the curve, kind of 3 months and in versus, the 20 to 30-year part of the curve, I would not be too surprised to, over the course of the next, call it, 24 to 36 months, to see less of a move downward in the front end, because I don't see the Fed having to really kind of go all the way down to anywhere close to zero. I think that experiment has been proven to not really work for monetary policy, and I would expect to see the long end of the curve move up somewhat, which is usually it's anchored to or it's keyed on long-term growth prospects. So I'm keeping an eye on the long end of the curve, but most of the action has taken place in the short end, and will likely continue to do so. What I'm being wary of, and what I'm having a lot of conversations with clients about, is simply because the market or a subset of participants assume that something is going to happen, such as cutting rates or a normalization of the yield curve. That doesn't necessarily make it true or inevitable. So I think it's really important for all of us as market participants and for our clients to really stress test their own scenarios and really to kind of invert things or look at them from other angles to try to get a better understanding, because things can be oversimplified, and that's when mistakes can be made. So I think there's a lot of danger in assuming that the front end will move down in tandem with other parts of the curve. So I think a flat curve is certainly possible. So we'll see how things unfold. It is still going to be quite data dependent, and we haven't quite touched on this yet, but the Fed has their dual mandate clearly in mind, and I don't believe that they're going to subordinate that or put that in a junior position to the election or to anything else going on geopolitically. They know what their job is, and they, I think, have been doing a pretty good job of discharging those duties. I think that for them to kind of fold or to stop doing that now would be a disservice. And I think they've got a lot of good ammo for staying the course, which does not necessarily mean holding rates exactly where they are. It simply means that they need to keep working towards their mandates and trying to screen out the noise. And sometimes the market is that noise.
Okay. And because you mentioned the presidential election, we're going to call that, we're going to check the box on that and say that we talked about the presidential election, because we don't have a lot of time, and I don't know where we would go on that one anyway. What I want to ask is another question from our audience: your thoughts on term maturity ETFs as a way to lock in yields. And this kind of segues us into my favorite topic, bond ladders, which in this group, I think I'm the only one that's their favorite topic. But anyway, Thomas, can you answer that question? Term maturity ETFs as a way to lock in yields?
Yeah, I mean, it's a way to get targeted exposure to a maturity range. If you're self-constructing a portfolio allocation in fixed income space, and you want to do the work of mixing and matching those ETF exposures, and you want those exposures to kind of wind down to maturity point and go away, yeah, I think they make a lot of sense, right? It takes away a little bit of the work of a bond ladder, insofar as the management team that's running those is going to handle the reinvestment of cash flows for you, right? But you still kind of have to, as an advisor, and deciding how much do I want to put into this term maturity and that term maturity and that term maturity, and then on top of that, what are those term maturities comprised of? Meaning, are they sector allocated to specific markets in the investment grade space, corporates, mortgages, is it all treasuries? So there's a number of questions that all kind of relate back to the idea of bond ladders that I think advisors need to think through before just saying, hey, I could buy a targeted 5-year maturity and then just hold it for the next 5 years and it goes away.
Rebecca, are bond ladders and bond ladder strategies better than any fixed income or passive ETF that Vanguard has?
Now that's a tough question, Jeff. At a firm where we provide mutual funds and ETFs, I have to paint the picture that I would say we can see both benefits and potential drawbacks of owning bond ladders. So of course, on the benefits side, we do see that there is a level of customization that you get as an investor. If you're working with an advisor to construct a bond ladder, you can have that tailored really to your needs around types of bonds that you'd like to purchase, and of course your timeline, your time horizon as an investor. So there is a level of customization, potentially tax benefits that can be accessed through that structure. Of course, there is the sort of behavioral impact of knowing the predictable cash flow, seeing the sort of time to maturity, and understanding when you will receive your principal back. That can be really powerful for some investors. And if that is one enabler to keeping those investors in the markets, then that can be a really powerful tool. On the other side of things, we do think there are a couple of drawbacks, at least to consider when it comes to bond ladders relative to potentially a fund or an ETF. Of course, in a bond ladder, you're typically not investing in quite as many bonds and therefore not having as much diversification. In our research, we see that, let's take a municipal bond ladder, for example, typically that's going to hold something like 20 to 30 bonds, whereas in some of our active municipal funds, we're holding anywhere from 3,000 to 13,000 bonds. And that type of diversification really in a fund can protect you from potential negative outcomes in any one particular issuer that you're holding. We also see a lot of benefits to funds and ETFs when it comes to transaction costs in the market. We're definitely seeing in general lower bid-ask spreads, just better execution when it comes to actually investing on behalf of the funds relative to what you might see in a bond ladder. And then, of course, there's just the concept of the reinvestment risk in a bond ladder. If you are holding a portfolio of only 20 bonds and one of those bonds is repaid, the reinvestment risk and the proportion of your portfolio that must be reinvested at that time is definitely more significant. You're more exposed to reinvestment risk than you would be in a fund with thousands of securities that are getting turned over, reinvested throughout time and each and every day, really. So those would be some of the key things we want advisors to really just weigh when they're thinking about what's better for a particular client, bond ladders or funds or ETFs.
Okay. And on that note, I think we're at time. Got to wrap it up here, folks. It was really good, entertaining, interesting. I learned a lot. I hope our audience learned a lot. I want to thank Cyrus Amini, Thomas Garano, and Rebecca Venter. And I want to tell our audience to go to ETF.com, check out the Advisor Center. There's a ton of stuff there specifically for financial advisors. Reach out to me directly if you want, jeff.benjamin@etf.com. I'm always looking for new perspectives and new ideas and new things to write about. But until then, thank you very much, folks, and we'll see you next time.